compliance in a country like Ethiopia where maybe things are not so formal, the regulation is a little bit soft, and it's more a matter of talking to the right entities within government and finding approvals from on high to make this happen because it's in the interest of the country. And so I think as we've grown, we've deployed 10, 12 million in assets. We're now getting ready to deploy 30. As we've grown, we're finding that the challenges with working with smaller projects, scaling up in terms of size and capacity, bigger tickets, comes with a level of overhead that is in one way justified, for instance, ENS requirements, but on the other hand is not sufficiently or is overcompensating for a perceived risk that is not yet qualified, if that makes sense.
No, I think that's a very good point about timelines from different lenders. I mean, I've experienced the same thing myself, which is can be very frustrating to get timelines to sync up between different lenders, and there's some value to having a smaller number of lenders so that less people do you have to coordinate with. What do you, in terms of like scaling up, like going beyond, CEI sounded like almost like a perfect storm of being able to provide all what you needed to go to the next scale, the next iteration. What are you worried about in terms of raise of financing? What worries you? What keeps you up?
So we're out there begging for $35 million to sort of finish the job here in Kenya, or at least get close to finishing the job. You know, covering every refugee in Kakuma with electricity in partnership, and then covering the northern 2/3 or so of the Dab, where the politics are a little bit easier before proceeding later on to the bottom third. That $35 million is not going to come from one person unless one of you has that today, but unlikely.
He doesn't apparently.
He does. He does. But IFC, it wouldn't make sense. That wouldn't make sense.
Wait till you meet our lawyers.
Will they trust me? I just want them to trust me, okay? So yeah, I think part of this is I would love to learn more from, you know, I think like Anka is probably, in Madagascar, is probably the company I should learn the most from on this, but assembling consortia of investors to do these very large deals is not, I don't have any experience with this, and I'm finding quite a chicken and egg loop with it, where everybody I talk to is demanding that I come with the other, whatever, 70% of the funding already signed, sealed, in blood, you know, and I'm like, well, no, everybody else is waiting for you to do that, and we're working on that. We're trying to get people in the same room to sort of all look each other in the eye and say like, okay, we're all thinking about this. Can we at least all go to the next step together? But that's looking like a challenge. I think it would be nice if funders could look at what we're talking about, which is the most efficient way to spend electrification dollars possible, which if anyone wants to beat me up on that, I would take it. But I think it just is, just because of the density of the communities and the fact that we're already established. And just take the risk and start the process, and let's do this together. But so far, that's been tough.
Viv?
Look, I think the raising of the funding has been easier for us because one of the things we did, one of our lead investors put up some TA. We hired a boutique entity who's been working with us on restructure plans, market consolidation, and raising money. And so I haven't dealt with a lot of that ourselves. They've been pulling, you know, players together, and that's been immensely helpful. Looking internally, my biggest concern is that we're struggling to manage the 700 kilowatts that we have deployed at a standard that I feel comfortable with, given my commitments to my investors. I'm petrified of how we're going to scale that up in an environment where we go to 10x in the next 3 years. That really, really worries me. I think it's for me, it's a much bigger concern than the CPs to disbursement and dealing with the lawyers and so on. So that I think is a real concern. And I think it's a concern for the sector because more and more we're starting to see companies going from 60 kilowatt sites to 300 kilowatt sites and 1 megawatt and 2 megawatts. And now you're no longer talking about 48 volts DC, you're talking about 700 volts DC. That stuff can kill you a whole lot quicker than the wall socket on the wall, right? And that requires a different level of capacity. And as a sector, we are not resourced to hire those kind of people. Because now we're competing with technical folk that are used to working on large energy infrastructure projects and getting paid large international salaries. And that is going to be a big challenge, I think. Now, I was prepped by Caroline, and like Lamida, I'm somewhat fearful of her. that we should be talking about success stories. So there's another 3 things I think I wanted to speak to, success stories and potential opportunities. The first one is that we're doing a pilot with a company called Electrify Solar out of Dubai, in which we are tokenizing kilowatt hours on one of our sites using digital ledger technology. And the principle is that we pre-sell the energy over a 10-year period. So we build a site, we commission, all of the kilowatt hours get tokenized, we pre-sell the energy to a fund that is funded by whoever wants to invest in that space. And this is a way of simplifying access into energy access projects on the continent without having to roll your sleeves up and get your hands dirty. So that's really interesting, and I'm excited about what that can do. In simple terms, it's like factoring with a bank. You have an invoice, the bank has relative high confidence of collection of that invoice, they give you 90% of the money up front, and they worry about collecting the invoice. And I think that is a huge opportunity for the sector in terms of generating working capital in a world where the sector is not yet ready to absorb corporate equity. And the second thing I'd like to speak to then is working with Vittori Energy, a startup out of South Africa, where we're doing now battery lease to own. Instead of replacing batteries, paying the full capital cost at once, we're funding that through them on a 36-month window. So we pay effectively for use, and after 36 months, those batteries become ours. Technically have a 10-year lifetime, so then we have 7 years after that. That's interesting. Why? Because it frees up cash. Instead of spending, I don't know, how much are you spending on batteries in Kakuma?
I think the bill was 700,000. No, with taxes, imports, about $900,000.
So if there were entities that were willing to fund that capex, that you'd pay a monthly bill over 36 months, and then you free up that cash for operations and scale up project development for your next phase, it'd be huge, right?
Anybody? Anybody?
Number 3. Yeah, and number 3, I think, opportunity. So there was a session yesterday on RBF. When I first started out here in 2010, everybody was talking about grants, and you had to define what you're going to use your money for, and there wasn't really, people were not to worry about it. Somewhere along the way, the donor community got together and figured out that connection-based subsidy is the easiest thing to figure out. It fits within the typical 3 to 5 year timelines. It's a thing that you can measure, and it's bright and shiny, and it's done. The challenge with that, though, is I think that it doesn't incentivize long-term sustainability. And I think that we should start to get serious, and I would love to see someone step forward with a kind of a pilot in which we look at funding not connections, but we look at funding kilowatt hours over the long term. That does 2 things. It means that as a developer, you're forced to raise your capex to build your site. That means I have to go and raise the money from whoever I can, not more grant, because CI Africa has already committed to $500 per connection effectively, but they would pay it out over 10 years based on kilowatt hours I deliver. And the second thing it does is it forces me to think really hard and to implement programs to drive demand. The more demand I drive, the more funding I get in the long run. And what it does is it evens out cash flow over time, which is good for any investor who's looking to yield an IRR.
That is fantastic, because what you're doing, and it sounds really exciting, but it's fantastic because it is the perfect segue to the next session, because someone's going to talk about that. So I want to keep the train moving because I really am scared of her whip. So can we give a round of applause to these guys for starting us off? Great. Thanks to both of you. So as many of you know better than me, is that this financing market is very bespoke. It's very specific to what we've been trying to do, energy access. It's not the same. Okay, got it. It's not what we think about. We think about financing motorcycles or getting a home mortgage. So we want to talk about some of the different ways in which the scene looks different for this space. So I'm going to ask 3 people to come up. I'm going to ask Ed Borgstein, who's an advisor to the Global Energy Alliance. You used to say People and Planet, but you've lost some P's. No, they're still there. Good. Okay, so Ed's going to come up and talk about a pilot that he's working on, and then we're going to have Chinua Azubike, who's the CEO of InfraCredit, our favorite topic about local currency. Where's Chinua? There he is. He's going to come up. You guys can come up on stage. Join me. And then we're going to have Katja Tauchnitz. I hope I pronounced that correctly. So I'm 0 for 2 on pronunciations on panelists. So I think we're going to try to cover 3 different parts of what the market looks like. I'm going to, just because Viv set it up so perfectly, I'm going to ask Ed to lead us off and talk about what GAP is doing and different ways of looking at that market.
Thanks, Don. And Viv, wherever you are, thank you. That was a great setup, and we didn't plan it. I'm really struck, and we've spent the last year in a group of different organizations trying to kind of take a step back and say, where are we on electrification progress, and what are the real numbers, and what's working and what's not, and where can we learn and kind of take the next step? And the first thing that really strikes me is the massive gap between the potential, costs have dropped, technology's improved, it's not that expensive to achieve universal electrification, and the way that we tie ourselves up in knots with financing models. You just heard from Viv and from Douglas about the challenges are all man-made, right? The challenges are all self-created amongst the different types of investors, types and donors, and that delta between what we should be doing, what we can do, and where we are now is still huge. We're starting to make incredible progress, and I think we're seeing amazing progress, especially on the grid edge, on CNI, on big loads, on clusters, on the types of projects we heard about now, on interconnected mini-grids in Nigeria, where there's big load. I think we're getting really good at meeting it. But 84% of our unconnected are still rural, poor, and agriculture dependent, right? And so the question that we're asking is, what's the next step? If we're using the current type of RBF models, partial capex subsidy and cost reflective tariff, to meet the needs of the first wave and to really get out the gate, what's the next step for doing something that reaches universal access? I do think, and Mission 300 is getting us half the way there, but the national goals are all about universal access, right? And universal access means you need to have a universal service obligation in a certain area, right? Sustainable access, and Viv, you raised exactly this point of what incentivizes and guarantees long-term sustainability of that access. And that's very hard to do with only an upfront capex subsidy. I think it was a colleague of yours, Don, that said we're trying to solve an OPEX problem with a CAPEX solution. And I think we need to take a step beyond that. And then the third point is really what I call adequate access. And that is providing sufficient power to grow economic development, but also at a price point that is consistent with being able to do successful rural businesses, right? That, at the end of the day, that's what we're all here for. So those 3 points, how do we get to the next set of delivery models that can help make those happen? And I think what we need is another toolkit of different approaches and different models to use alongside what we've got. And there are some people doing amazing things. I'm sure lots of you have seen the Rural Energy Access Lab who are doing solar home systems as a service. I think we've got lots of models being piloted in different places. And we're with a group of organizations, including Lightrock, and I know Lizzie's here somewhere, we're going to publish in June a paper talking about some of these different models. But I want to talk about what we're trying to do in Zambia, which is where we want to test some of this. We're going to work on a model with essentially 2 parts. It's very simple. I've tried to simplify this. We've got hundreds of pages, but really it's 2 things. One of them is concessions, and that's the C word, and some people hate it. And there are lots of failed examples. But what can you do with a concession? You have a defined service territory, right? And within that service territory, you can mandate universal access standards, and you can mandate a price, and you can mandate a tariff. Okay, so that's step 1. You've got a service territory in which you need to provide a minimum level of service, and maybe it's 3 kilowatt hours a month, which, by the way, is what most rural households use when you give them unlimited grid access at very cheap prices. You need every household to get to that basic level. I think that's a social service, right? And then you provide volumetric power per kilowatt hour to the bigger customers who need it. Okay, so you've got a service territory, and you, the operator, define how you're going to do that. If it's a small modular nuclear reactor that's the least cost solution, then do it. I don't think we need these kind of tech silos. I think DREs are modular, they're scalable, they can do all these amazing things. Let's allow them to do that. That's part 1. And you design for the demand that's there today. Then part 2 is you make it look like a regulated model. I think the innovation is really exciting, but I also think we kind of want this sector to look a little bit boring, like a utility in other parts of the world. And utilities function with regulated returns. And if we can give a model where you have regulated returns, so the difference between what you collect from your tariff, which probably isn't enough to cover everyone, it's probably not going to be possible to be cost reflective at the level of an individual village in a rural area, right? And I think we need to accept that. Cost reflective over the long term, no matter how much capex subsidy you give, we need to have some way of regulating that return. And that comes in as a revenue settlement mechanism, the difference between what you collect and what you need to pay. And the World Bank can pay that for several years. A tariff levy can pay that for the longer term, which already exists. The amount of tariff levy, 3% of the tariff levy in Zambia that exists today should raise about $50 million a year. That's $20 per household per year for every unelectrified household in Zambia. That's enough to pay the difference between a very low level of, a very low cost for the consumers, $1.50, and what it costs a supplier, a provider, an operator, to provide tier 2, 3 kilowatt hour service, right? It's not a big secret. There's enough money in the system to provide universal, ongoing, guaranteed, sustainable access with existing tools. If you make it look like a regulated return, this is the last thing I'll say and then I'll pass it back, then it becomes bankable, right? Because you've got all of the things that Lizzie and Lightrock look for. You've got guaranteed revenue streams. You've got bigger ticket sizes because you've got these large kind of defined concessions. You're no longer a developer who needs to go out into the world and bravely chase and find demand. You're an operator who's focusing on delivering long-term guaranteed access to large populations. And you've got, hopefully, a meager guarantee wrapped around it to deal with your ongoing payment risk. So that's where I want to end. I think we're going to try this model out, and we'd love to share this with you all. It's one model. I think there are lots, and I think we're at a point where, as a sector, we can be thinking about what are the next steps, what are the next sets of delivery models, financing models that we can use and that we can test. I hope we're going to be on ground with a few developers later this year, and we would love to share with you what we learn, what we get wrong, and hopefully something useful. Thanks.
Thanks, Ed. That's really great, because I think what you've underscored is the idea, number one, that this is, if we start looking at these as service models, it opens up a wealth of possibilities about how that gets executed. But the second thing is if you focus on with getting a regulator to come along with you to try this out, hopefully it's in the long-term benefits of the government as well, and we need to find more governments that want to try this sort of scheme out, because we are looking at developing that investor bankability. So we're really going to look forward to those results, and hopefully by next year we'll have some things coming along. Great. So Chinua, you've got this really, really tough topic. So I'm really looking forward to you telling us what are you doing on local currency, and how do we replicate that outside of some of the bigger markets, and how that's going to hopefully be available for DRE.
Thank you, and it's indeed a pleasure to be here. Great to catch up with you again. So I think just a bit of context. We all know that, infrastructure and energy access is paid for in local currency. So when we think about sustainable finance, we cannot sustainably finance a mismatched sort of asset class where the end users pay in local currency because they earn local currency, but the liability on the asset is, in foreign currency. And what InfraCredit was set up to do was to de-risk and mobilize long-term finance in local currency. The context of this is that in Africa, broadly speaking, we have over $2 trillion of domestic contractual pools of savings in pensions and insurance. These monies can be invested locally. We know it's proven because what InfraCredit has done over the past decade has been to address this gap between perceived risk and real risk by guaranteeing access to finance for first-time borrowers in local currency and mobilizing pensions and insurance investors to lend to projects. Now, that is a category of investment-grade projects. So then, therefore, the theory is that we don't have a capital availability problem. What we have is a perception of risk, asset quality, and intermediation gap. So there's more money than there are actually projects that are investable. And if you take that and bring it to the mini-grid sector, or the DRE sector, as it were, broadly speaking, the same statement is that there's more money, potentially, in local currency that can finance quality projects. And then we go to, okay, well, what is an investment-grade DRE project? Therein lies the puzzle, right? It's this puzzle of what is bankable, what is investment-grade. And I think, Don, you made a point around the design of the M300. It's a very ambitious program, but it starts by defining 300 million people, which sort of defines the incentive mechanism. You're connecting households connecting people, and that's how you're motivated. But we also know that contractual cash flows, commercial cash flows will come from the equivalent of commercial end users in the same rural communities that you talk about. So there's a design problem, and this has also impacted on the business models that you see. So we spent some time, again, working with our partners, some of which I'll mention, GIA being one of them, to assess in Nigeria over 40 developers operating in the mini-grid space, just to understand the root cause of the problem, because sometimes we say finance is the problem, but the root cause of the problem is beyond finance. We saw that because we had looked at over 40 developers seeking over $500 million of financing, and certain things kept popping out consistently from the due diligence data. So the due diligence data was telling us that there is a challenge with the understanding of what is, a business model, financial model, feasibility study, the PPA, the contracts, the ESMA. So these things kept popping up as due diligence issues. Now, these developers are as intelligent as we are. I mean, I could have been a developer. So it's an asymmetry of information problem. It's not that the developer is less intelligent than the financier. It's just that the financier happens to know something that the developer doesn't know. So the question is, why don't we make these frameworks transparent enough that the developers understand the 7 or 8 or 9 things and the form of them? So we went through a process of developing a toolkit experientially, breaking the DRE sectors into 10 different business models. Again, for clarity, because interconnected mini-grid is not isolated mini-grid and it's not mesh grid. The business models are different, the risk profiles are different, the contractual arrangements are different, the financial modeling is different, and so we had to even divide our internal teams to clusters so that we could focus on what exactly is the market failure here. So we've developed rating models internally, credit rating models, and these are not, I'd say, episodic outputs. These are actual rating models being used to try and assess transactions. So it's real-life tools, and that we developed that to even within as a lender to say, what does bankability mean? Because it's shockingly, you find that a lender can't, or a financier may not be able to define what bankability means when you ask them to transparently explain that. So we wanted to stop it from being a moving target to something at least we know. We keep improving on it, but at least there's some level of understanding of the 8, 9 things and the form of them that if you provided it, you have a strong probability of raising capital from a financing standpoint. So we did that. And then the next step was, now we know. Does the developer know? And how do you educate the developer to understand these requirements? And then we started talking to GIAP to get some money to essentially institutionalize the toolkit by setting up a separate team, which is a set of about 30 professionals currently. So we're educating a set of team members that are not within, if they're separated as a DRIF, is an energy facility, that is now focused on working with these developers to integrate into the preparation and development process those toolkits and those standards. Now, expectantly, what this hopefully does is that it improves the quality and standards of documents that are prepared, but more importantly, builds capacity at the developer level, because ultimately you're transferring knowledge to these developers. Of course, there's still additional points around the sort of maturity of the developers and the operating capacity. Those will be dealt with alongside. However, the most important thing was we want a developer to submit documents and have a better understanding of what the lender wants. So for us, that was a basic test we needed to deal with. But even through that process, we started understanding better what the actual challenges were. So today, at least within the team, there's an understanding of what is an investment grade mini-grid, interconnected mini-grid, mesh grid, and if you submit X documents, ultimately the underlying issue was productive use and contractual cash flows. How do you get that? Because how do you get an investment grade beyond grants? We know grants are there, but we see grants as transitional. We see grants as playing an equity role to bridge the gap, but they're not a permanent fixture. And neither is guarantees. Guarantees don't make bad projects good. Guarantees help to bridge a gap of knowledge. And so we also see ourselves as working ourselves out of a job ultimately by making sure that we develop projects that can actually get their own independent rating to access capital. So it's a journey, but at least there's clarity on the process and the pathway. So we know where we should be in a year, 2, 3, 4 years' time because we have a clear strategy. So this has taken us on a journey sort of a journey of discovery that we believe that, to achieve private capital, because we talk about it like it will come, but it has terms and conditions. But understanding that means that we can unlock domestic capital at scale, incrementally over time. And so today we've been able to develop blended solutions where we get first loss capital to reduce the interest rate. We've been able to create co-guarantee solutions working with our partners, FSDA, BII. And this allows us to solve for a system problem, because what we realize that the challenge beyond this is actually systemic. It's about looking at the capital stack from early stage to construction finance to long-term finance. And are these capital providers in sync? Because, the journey and the experience of the developer needs to be smooth. And so you need someone who's like an underwriter, who's able to lead, manage capital raise in a way that reduces the burden and, creates symmetry of knowledge amongst financiers. And this was the same feedback we got one of the sessions we sat on. So I think going forward, this can be institutionalized. So when we say unlocking local currency financing, you have to walk back to the market failure and then say, okay, if we solve this, does it unlock local currency financing? I think that if we solve this alongside, obviously, the instruments we have, we can unlock local currency financing at scale. So it's not that the capital is not available. We've unlocked $500 million across 11 sectors in Nigeria. So the capital is available from pension funds, from insurance, is the how. And I think we're in the process for the how. Obviously, thankful to our partners who've supported us in this discovery journey. Well, we're happy to share more knowledge on what we're doing in terms of just understanding that the pain points is really the process through which projects are developed, and ensuring that there's an exchange of knowledge to the developer to understand what's the right business model, what's the right approach to take. And that helps us to even work with our partners towards where intervention should be, really. Thank you.
That's really great. I think we spent, please. We spent the last hour and a half before lunch talking about the need to improve developer capacity. I think what you hit on is this idea of having these credit rating models across the different segments of DRE. What you're talking about is actually developing capacity, not just at the developers, with the banks, right? And this is maybe something we can figure out how we could roll out, not just in Nigeria, but in other markets, right? Because in my own experience in other sectors is that a lot of times banks, people that run due diligence will come to us and say, we think we want to be involved in this, but I have to convince my boss to take this to credit. So a lot of it comes back to capacity of people that work in the banks. They may have risk perceptions, but a lot of the time it's just about building that internal knowledge. That sounds like a great way of getting local banks to take this journey with us once they can understand really what investment grade looks like, and then how do we bring it to actually starting to have funds flow from local banks. So thank you for that. That's a great point. Katya, I think at Triple Jump, you're looking at these different sort of blended finance models. Chinua started talking a little bit about that, but why don't you give us your perspective about what works, or where do you think, where this is going with blended finance?
Yeah, sure. So first of all, Katja from Triple Jump. Triple Jump is an impact investment manager that currently has two mandates in the access to energy space, being the EGF that is focused on other subsectors other than green mini-grids, and also CA Africa, the project that you've heard name dropping 20 times by Douglas and Viv already. Say Africa is a foundation that was created by the German Development Bank, KfW, offering different financing solutions across the sector, including solar home systems, CNI, but with a strong focus on green mini-grids and productive use of energy. I have to address a couple of comments that that Viv and Douglas mentioned. So first of all, thank you very much for the feedback. I noted it down and bringing it back to our team to work on that. And I really appreciate you recognizing SEA as a one-stop shop solution for green mini-grids, and that's what we're actually aiming for. So SEA Africa is offering different financial solutions, one being REF grants being dispersed based on connections built, but also what we call smart outcomes grants. Those are going in a little bit in the direction that Viv mentioned. They are not dispersed once connections are made, but once social impact is actually achieved via the connections to the green mini-grids. So they are dispersed a year later after a productive use of equipment, a productive use of energy equipment is actually installed in combination with a green mini grid. But of course there's a financing gap. Once you have the RBF approved, you still have to have funding to actually achieve those results. So South Africa is coming in there with two different solutions. One is what we call the forgivable loan, which is basically, our legal team doesn't like me to call it this way, but they are not here, so I'm saying it anyways. It's kind of a pre-financing mechanisms for the RBF, so up to 30% of the RBF being awarded can be dispersed as a forgivable loan, and once the connection target is actually achieved, the loan is converted into a subsidy. So all the interests are forgiven, thus the name. And if this is not enough to bridge the financing gap, South Africa can also come in with investments via our crowd lending window, and both those operators have benefited from it. And I think I saw One Power somewhere in the room there as well. So they are our key partners for the green mini grid financing offering. And we are via our investment window, we can offer debt, mezzanine, equity, basically anything. Although I have to say, for now, we only offer debt for our green mini grid operators. But in theory, we can also offer equity. So the idea is really to have this one-stop shop, as Douglas mentioned it, for green mini grid operators, hoping to close this financing sequencing gap that was mentioned earlier, with the challenge of different investors coming in at different times with different criteria. And we're hoping by offering those solutions from one institution, we can bridge this gap. But obviously, we're also still learning. The foundation was created in 2021, and with Kudura and Renewware being our first generation green mini grid grantees. So I hope those that have benefited from the second round of grants had a little bit smoother processes than the ones that we heard earlier. So yeah, so South Africa is basically aiming to be this one-stop shop, offering blended financing solutions from one source for green mini grid operators. And we would love to finance more portfolios of green mini grid projects out there, but the reality is there are not so many bankable, financeable portfolios of green mini grids out there because of this financing sequencing gap, but also the risk ownership gap that we see. We do see that there's a misalignment of investors in the space, coming in with different funding criteria, especially in like ENS and stuff like that, where we're probably a little bit stricter than other investors, but also in terms of funding criteria, timing, and risk perception. So I do see there's a need for investors, be it equity investors, debt investors, but also RBF providers, to actually sit together and try to close this financing sequencing gap and aligning on their funding criteria to be able to offer financing for portfolios and not on a project by project opportunities.
That's great, thank you. I think you've seen, we're talking about things that improve bankability, that improve capacity of lending. How are we getting to the ultimate source of financing, getting scaled up in this market? We're going to keep this to be, some of you may have questions. I also have my own questions. We're going to try to hold all this to the end, just in case if any of the speakers have asked something. They're all going to be brought back up here if we need to answer questions. But I'm going to try to keep this moving so we keep the speakers keeping it just a short amount of time. So we're going to try to keep this like speed dating. So so if we can give a round of applause to Chinua, to Ed, to Katja. Thank you very much. I'm going to bring up the next group. So what we've arranged is this in sequence. We've kind of talked a bit about the market. We've talked about what's been working. Now we're going to hear from practitioners. We're going to have 2 from the equity side, 2 from the debt side, to speak about what it is that they financed and what it is they think is bankable. So if I could ask, we're going to have Lizzie Bini Amisa from Lightrock. She's one of the partners who runs a fund for energy access. And then we're going to have Idris Taibi, who is the managing director from Inspired Evolution. Inspired Evolution, which is the investment manager of the fund that IFC spearheaded called Zafiri, that you've probably heard about. Now, all the Zafiri questions go to him. Congratulations. And then we're going to have Jiwoo Choi. She is a chief of strategic initiatives at Acumen, the hardest fund, also an IFC investee. And then last but not least, Lars Coleman, who's an executive director at Signum Capital. They run several different debt facilities that are providing funding into this space. So 2 from the debt, 2 from the equity. I think I'm going to give each one of you a good 10 minutes to talk any specific examples. You don't have to use names, but if you can try to be as specific as possible as to what things you think are bankable, whether you've done them in the past or things you're looking at now, to give people a sense of where you come at from the equity or the debt side. So I'm going to start with Lizzie. I know she didn't like me starting with her.
I always start first. Hi, everybody. My name is Lizzie Bainiamisa, a partner at Lightrock. I'm head of Africa for our cross-regional energy access and energy transition fund that covers Africa, the Indian subcontinent, and Southeast Asia. I come to this work having been a project developer at Global Ec and Infraco for about 12 years, and then I was a partner at E3 Capital doing energy access and climate tech on the venture capital side for about 3-4 years. Our focus in the energy access and transition space, so I think it's more energy transition in the Indian subcontinent and Southeast Asia than it is in Africa. 60% of our funding is spent on what we say are core sectors. Those include solar home systems, mini and metro grids. It can include battery as a service, depending on how those batteries are used. CNI for residential and SMEs, as well as modern cooking. So we don't say just clean cooking, because we are allowed to invest in LPG as a transition fuel. And then 40% of our funding goes into what we call enablers. That could be anything else. It could be EV, it could be energy efficiency software, SaaS. It really could be anything productive use where energy is the main use case. And the way that we look at this sector, we're a 10-year close-ended fund. It was a mandate that was tendered about 4 years ago. So we do have a limited life. We're not a permanent capital vehicle. So we are looking for scale. Our ticket sizes range from 10 million to 40 million. And so I guess average ticket size in a portfolio like this is anywhere from 15 to 30. That could be single ticket, or it could be over the life follow-ons. And so I know Aegis is going to save us, but scale is the biggest thing for us. I think I've been in this space. I look young, but I'm old. I've been in this space for 18 years. We've talked about consolidation. We've talked about building at scale, and particularly in the mini grid and metro grid space. I worked on Nuru in DRC for about 4 years. My former fund led the Series A in that deal. And while we got the Series B across the line, it took about 3.5 years during COVID. It wasn't the perfect deal, but it was the deal to be had at that time. And so if I look at a deal like that, that's now going to have about 7 megawatts spinning on the solar, battery, diesel, and where they they have amortized hydro that they've also been able to link in. And the next phase of thinking through how you take that, take it to the next stage is a platform, a portfolio platform. I could say the same for Energicity in Sierra Leone, and a lot of the players that have been doing this for a very long time. And that's what I think we're hoping to do. I think when I look at this space of energy access, you know, for better or for worse, oftentimes venture capital is the first capital that's available. And so you have a lot of companies that were funded by venture, also funded by concessional funding, and they get to a certain place and a certain scale, and they're not quite growth stage yet. And so what I like to say internally is that I look at our funding as two things. One, rebasing the ecosystem, because some of these companies do need to be restructured to be able to achieve that scale. And two, the gap between kind of venture capital and project finance at scale. When we're looking at, I loved what Chinua said about contracted offtake. For the larger commercial grade entities that we're looking at, that is a big driver, being able to say fund data centers or telcos, critical infrastructure, water, hospitals, to be able to be the critical and the massive amount of offtake, anywhere from 50 to 70%, to then make the case to extend the TND to homes, SMEs, and the like. And then on a portfolio basis, at the top end, you have off-takers that are commercial, taking 24/7, 365 power, and be able to almost cross-subsidize on a lifeline basis for those who are either first-time energy access or replacing kerosene. As we think about blended finance, there are segments of first loss and subsidy that will be very helpful for that last mile kind of lower, I would say, capacity offtake. But at where we are, at the size of fund and what we're looking at, that's kind of where we will be playing in this space. We also have a $25 million TA facility. 60% of that funding goes to support our portfolio companies, and then 40% of that funding goes to support the ecosystem. So Ed was talking about the paper that's coming out with Lightrock and GAP. That's the funding that's going to be supporting that. And so I'll end there, but I'm open for questions, and I'll leave space for my other speakers to also speak. Very nice to meet you all.
That's great. Thanks, Lizzie. I think we're going to flip to the debt side. We're going to go back and forth across the divide. So, Jiwoo, take to talk about what you've taken a look at so far with the Acumen Hardest to Reach Fund.
I think so. Thanks, Lizzie, and it's lovely meeting all of you. My name is Jiwoo Choi. I'm Chief of Strategic Initiatives at Acumen, leading Hardest to Reach initiative. And then, as the name indicates, our goal is to leave no one behind. So we target countries where electrification rate is lower than regional average, which was 50% 3 years ago when we started, and poverty rate is higher than regional average. So we intentionally selected 17 countries, and that's where we are. And we finally had the final closing in December last year at $250 million, thanks to our partners, IFC. So that's what we are trying to do. And then, you know, Acumen's journey in this sector has been quite long, I have to say. We started investing into off-grid solar sector in 2007 when it was an idea. So what we have seen is, you know, from the idea to the industry. And the lessons, I think I joined Acumen about 4 years ago from institutional investor side. And what I have learned for the last 4 years in visiting the companies, meeting with the stakeholders, no two country is the same, no two company is the same. Then our question was, what's the right kind of capital to the company? We love to get to the scale, but in order for us to get to the scale, what are the steps? So that's actually something that we are still trying to figure out and learning with the company and by deals. Maybe I can share specific deals that we did. We actually found an amazing local company in Malawi who's actually driving the energy access rate in Malawi in rural area. And when we looked into them, I can say their name. We are very proud to partner with them, Yellow. So their operating platform was very strong, and they have amazing impact, track records, and their financiers are also very solid. And we started to talk about what's the right kind of instruments that we can work together with them. And thinking of Malawi, where US dollar, liquidity is very low. So if we give them, let's say, US dollar, if we give them local currency loan, which is definitely needed, then they have to convert it into US dollar, and in the process, they will lose a lot of money. And then, because of this very low liquidity in US dollar in Malawi, it takes time, it's hard. Then, US dollar loan, the devaluation of the local currency in Malawi at that time of our discussion was crazy, I have to say. It was just 1 month, 44% devaluation. It's like our US dollar loan could end up as the most expensive financing that they ever have. And then that could be a burden to them. And unfortunately, that could kill the company too. So then we were like, well, what could be the right structure that we can do for this company? So what we did at the end is we provided them US dollar funding for them to buy the inventory, but we enter the cross-currency swap for the receiving end of it so that they can repay us in local currency. But it was like building block. We need many pieces to put together to work. Because, the cross-currency swap in Malawi, there's not many players, and it's very expensive. So as a lender, it's actually not an easy choice because we have to compromise our return. And that's when EU came up with the concessional hedging program. So we actually benefited from it. So as a lender, we actually get to the risk-adjusted return that we needed. But at the same time, we were able to provide, I think, the right kind of capital to the company. So that's just, I think we just got to be a little more conscious of and tailored to what the company needs, and rather than what we have. So that's actually one thing that I wanted to share. And I don't know if I can share another example. And another transaction that we are actually closing is receivable financing. So I think receivable financing is more for mature company. And if we look at the paygo companies, 60-70% of their balance sheets is comprised of the receivables, account receivables. So, and then, thinking of Africa, thinking of this sector, funders are come and go. The companies need very, I would say, sustainable, consistent liquidity provider. So if there's a SPC, like intermediary, who actually buys receivables from the company and package it for senior lenders to come in, that's another way to do it. And then, so that's another transaction that we are closing. So I will not actually name, but many of you probably know what transaction that we are talking about. So what that enabled the company is monetize their assets for their growth. So they don't have to go for lender, equity provider to fund their growth. Rather, as they grow, they can just sell their assets and finance their growth. So that's I believe is sustainable and systematic way for the funds to for the company to have access to the liquidity. And what I'm actually hoping through this structure is this remind me of the first transaction, first actually credit cards asset-backed transaction in Asia. So it was in 2002, a long time ago, when I was with the rating agency. So we talked a lot about rating agency and credit model. But what happened was, so credit cards business at that time in Asia was very new. So the credit card companies were actually having a hard time having access to the financing. So what they did is actually they put together the asset-backed securities backed by their receivables. So first transaction that the credit card company did, the subordination was very much needed. So it was very expensive financing for credit card company, but the asset-backed security means they have to disclose the quality of assets to the investors and to the public. So that actually pushed the credit card company to enhance their, I would say, the underwriting policy, underwriting processes that enhance their actually asset quality at the end, that enhanced their credit quality. So through this asset-backed security journey, they actually got their credit rating upgraded, and then they got cheaper funding from in primary loan markets. So, right now, what we talk a lot about perceived risk and real risk. So can we actually put together this data that we are looking together and then make it as public goods so that can actually encourage the company to, enhance their operation as well. And at the same time, enhance the transparency for the investors to come. That's to me, only way that we can bring in investor, like institutional investor, into the sector. And that's where we can see the scale for the financing and the projects. So I think there's many different ways that we can put our heads together and what could be the right structure for the company, for the project that we want to fund together.
Thank you. That's really quite interesting. It's something I hadn't thought about before. Maybe that's something we need to put on the agenda is to what extent can we really start trying to pool the asset quality of things that are being funded and how can we make that information available to the financiers, right? It's a great idea. Thank you. Idris, I know you're relatively new to your job, but the market is not new to you. So I'm really curious to see what you say about some of the war stories you may have already seen in Africa about financing.
Yeah, so thanks, Dan. So my name is Idris Taibi. I'm the new managing director for Inspired Evolution, leading the Zafiri initiative. I've been around for a while since I've been working in the energy access space for the last 10 years. I had an exposure to Haiti, to very complicated markets. And over the last couple of years, I've been managing actually a platform dedicated to fund mini-grid assets. So I think that on my side, when we need to write the coming equity story for the sector, first of all, we have to agree on the status of the market today. So it has been very challenging over the last 10 years to grow the companies of the sector. And there are a lot of reasons why. It's new business model, new technology, new regulations, everything coming all together at the same time. The other thing that we need to remember is what is the fundamental business that we are working on. We are working on the utility sector and infrastructures. So once you have said that, what does it take to build profitable companies in that space? Utility is about volume. So what does it take to go from where we are today to where we want to be tomorrow with the huge objectives that we have? The last couple of years have been focusing a lot on bankability of the project, structuring properly the assets and the companies as well. What we tried to deploy was something coming from the infrastructure world and from the utility world, but applied to SMEs. So that's the reality, and actually what it created was a lot of friction, costs, transaction costs, for example, structuring costs, putting a lot of focus on something that was not really yet. So I think that to bridge the gap and to go where we have to go, we need to assume the fact that mistakes have been done. The companies were probably not all ready to go where we want them to go. And actually, I think that the Zafiri's mandate, which is to crowd the ecosystem, to play a catalyst role in the equity sector, because obviously Zafiri first phase will be 300 million. Hopefully, we will reach a second phase that will be 1 billion. We've seen the numbers from AMDA. We need 46 billion to electrify the sector. So Zafiri will not make it, but we hope to lead the way because there was a gap in the market, in the equity market. There are lenders, but the lenders were waiting for initiatives like Zafiri to come with the right instruments. The question we have to ask is whether the project financing that we have tried to apply to small assets was the right approach at this stage of the market. I think that it will be tomorrow. But I have experience, I worked for large utilities, I've financed coal plants, combined cycles, and these kind of things. So you can't do a project financing and assume the cost for this approach for large assets. You cannot pay $500,000 for a $4 million loan facility. That's a nonsense. So we need to agree on what has been done right, what we did wrong, and move forward and see when this target of having sustainable companies with good management team, good governance, and operational excellence, which are the keys for the utility companies, what we need to bring the companies there. So that's really, I think, and if you want to, just a couple of words about my experience, because we have a lot of scars. I mean, there are people in these rooms that have been through very complicated situations. I think that we have entrepreneurs in the sector that have all the knowledge that is necessary to make that setup work. So we need to capitalize on what has been done, have again a common understanding of what went wrong and how we can adjust. And I think that Zafiri's role is actually to make sure that this will happen and we can move forward on a clean way and a sustainable way.
Great, thanks, Idris. I think you're, so far, we're not done, but you're all being very polite. So I'm going to ask you, this is your first question after Lars speaks. I need you to tell me an example of one company that you didn't fund and why. Okay, that you did not fund, that you turned down. Specifics, yeah? We're here to talk about specifics. So now we're going to hear from Lars. If you want to cover that now, you can cover it now. If you want to do your normal talk and then give the rest of these people a chance and you can come up with your one scar, that's fine. But let's hear what Signum has been doing with respect to these debt funds.
Yeah. So hi everyone, my name is Lars Koman. I'm with Signum Capital. Within Signum we have two pillars, asset management and advisory. I'm representing today the asset management side. Under asset management, we manage more than $1.3 billion. All of it goes into Africa, over 7 different funds, most of which are debt funds. And 3 of them have a direct mandate to do distributed renewable energy. Historically, most of the investments we've done were into C&I. We've also done several mini-grid investments. But to be fair, it was much more challenging to do these mini-grid investments. And that is also because our funds capture not only mini-grid, but C&I projects. So you're in direct competition with C&I project. So what I want to do in this 10 minutes that I have today is to sort of draw from our experience in the C&I sector that went through the transition of going from project finance to corporate finance and see where there are some lessons learned in the mini-grid world that we can apply. And also talk about our experience directly with mini-grid companies and how we think they become more bankable from a lender's perspective. So I want to look at 3 things. First of all, the mini-grid companies itself, then the equity, and lastly on sort of transaction structural elements. And I think the goal that we all want to achieve here is to move away from micromanaging inputs and judge mini-grid companies like utilities by their outputs. And that is in all our interest, because even as a financier, doing the micromanaging takes too much time, is not fun. We don't want to do it. So the first point is on the company itself, and before going into that, I want to highlight the complexity that from a lender perspective, we see in mini-grid companies when we compare them with other asset classes. So from the technology side, it's much more than just a solar panel. From the contractual framework, it's much more than just an offtake agreement. You have concessional agreements, EPC agreements. So it's a lot of things, usually in challenging and different jurisdictions, all at the same time, and all operated by a company that is fairly new to that game. So we have to find a way to get comfortable with the ability of the company that you want to invest in to manage these risks. So one of the key things that we've observed is, or that we ask our potential borrowers to invest in, is CFOs. We think that it's extremely important for a company that is raising capital to know exactly what they're doing. And I think there's a lot of good initiatives to sort of like build the capacity, but ultimately we believe that the whole knowledge needs to be within the company. It can be built from outside, but the advisor, to be more concrete, should not own the financial model. The financial model needs to be owned by someone within the company. Someone else can build it, but someone within the mini-grid company needs to understand how it works. And we've seen a lot of projects going wrong because that was not the case. The next thing is, or maybe one other thing to mention there is, sometimes you also have misaligned interests. So if you have an advisor company that helps raising capital for a mini-grid company, they might have different incentives and interests than the mini-grid company itself. So they are usually paid by the amount of capital raised, whereas the mini-grid company needs to think about the next 5, 10, 20 years. And we see a lot of mismatch there, not only in the mini-grid sector, but in the finance sector as a whole. The next point is legal expertise, and there, I think there are different schools of thought, whether you have an in-house lawyer or you work with external lawyers, but try to make, what the bottom line needs to be that your people understand the kind of contracts that you entered. Sometimes I think having one lawyer in-house can be an issue, because then the lawyer gets all the NDAs, gets blamed with all the legal work. What needs to be ensured, though, is that the CEO and sort of like the key staffs understands what kind of contracts are being entered. We've seen a lot of companies signing grant agreements, signing debt facilities, and they didn't understand what they were signing up for. The last thing, and that's a conclusion from our experience in the C&I sector, is sort of local teams. So companies that have require a lot of understanding of the local context cannot have all the senior management abroad. You need to have foot on the ground to be able to answer to short-term changes of the market conditions. Next, I want to quickly talk about equity, and we all know that equity was and has been the key bottleneck for many mini-grid companies to grow. And what eventually then happened is that many mini-grid companies started to take whatever they could. So they raised capital from the cap tables were overcrowded, a lot of different instruments, some long-term, some short-term, and that results in problems. You have different incentives within the equity structure. Sometimes you have no clear leadership on the equity side. So what we'd like to see is few equity investors and clear leadership, because that ultimately shapes the strategic direction of the mini-grid company itself. And the last point I wanted to quickly touch on is on the transaction structure, and I think we've had a lot of good input on this today. So the key things here I want to quickly talk on is concessional capital. So we all know that mini-grid companies need some form of concessional capital, and we've seen a lot of RBFs in these structures. What is important from our perspective as debt investor is, and I think there are a lot of good initiatives on standardizing these RBFs, but what is important for us is to ensure these instruments are really equity-like. So if there are milestones in there, they need to be objective. If the mini-grid companies reaches these milestones, they need to be sure that they will receive the grants, and that the grant provider doesn't run out of funding or there are other reasons why they can't pay it. And the second thing is, often these RBF agreements, they include specific repayment and clawback conditions. And it needs to be ensured, and this is something we've been discussing with many grant providers, that any clawback to any of these RBFs is subordinated to the debt. Otherwise, it's going to be difficult for the debt providers to accept RBFs as equity-like. And then the second point on transaction structure is sort of to minimize exposure on other variable risk drivers. So more concretely on interest rate risk and, local currency risk. So there are a lot of instruments on the markets. It's not ideal, but we've seen in the C&I space and also in the IPP space that companies raised floating rate debt and didn't enter hedging agreements and then had issues to service the debt because the floating rate went through the roof. So in mini-grids, we already have enough risk factors on the ground. We don't need interest rate volatility and local currency volatility to be another one. So that was my last point. So just in short, for us to be comfortable, we need strong management, capable operators, patient-aligned equity, and a robust transaction structure. And then I think as a sector, we can transition from project finance to platform financing, to the corporate financing that we all want. And maybe just one last additional thing in terms of instruments that we ourselves look at the moment. I think if you were to think about the ideal financing we as debt fund can provide, the ideal one would be a mini-grid platform that has been operational for 3, 4, 5 years. So you have an operational track record. So you have sort of like brownfield, you have data about the demand, you have data about the demand uptake, and then run a corporate financing facility. I think the way we did it in the past, to go in at construction phase with a project finance mindset, was not the right tool for the problem we have.
That's really good. That checklist of sort of like really what you're looking for is what we wanted, where we wanted to go with this conversation. And I always, when it comes to this space, I usually wince when people start talking about project financing, because this is not the right instrument for this market. It's not about cash flow based lending. It's too difficult. As you said, we already have enough risk factors in this space. We don't need another one. Anyway, so I'm going to kick off the questions. I've already given them a preview of my question, but I want all of you guys to start thinking about what questions or comments you have for them, as well as any of the other speakers. We'll make it a very open discussion sessions. It looks like we're going to probably have maybe 20, 25 minutes for that. So, yep, okay. So first, we're going to go back to the panel. Lizzie, what's a deal that you saw that you didn't finance, and what was the key reason? You've already had 5-6 minutes to think about this.
I know, but it's also, yeah, okay. I'll tell you the type of deal. I think earlier stage deals are harder for us to take greenfield risk. You guys hear me? Sorry.
Just hold it close to your...
Yeah, I think greenfield risk is hard for us just because we're a limited life fund. If we look at our hold period, we have 5 years to invest, 5 years to harvest, maybe +2. And so to Lars's point on track record and having, I mean, it's not spinning, but I come from the gas-fired world, so spinning assets that are actually generating revenue, and you can see line of sight to profitability, at least on each site, and then closer to that on the consolidated basis. I think what's also really important for us is that where there's a concessioning scheme, having really good relationships with the government, having those really panned out. We went through the rigmarole in DRC on Nauru because as MIGA was considering and ended up did cover that company, the idea that the concessions were national, then they moved to provincial, so having a provincial backstop instead of a national backstop, and then getting the regulatory approvals for the tariffs and the like were really important. So not to name names, I think we back into our portfolio construction given that our mandate was set. And so hopefully in our next fund we'll be a little bit more broader in what we can do. But in this one in particular, I think early stage greenfield outright risk is really hard for us.
So on my side, I can only talk about the deals that I did not do in my previous life. But I think it's still interesting in making the link with what you talked about when it comes to project finance. So my main shareholder in the company I was leading was a large infrastructure fund without the type of constraint in terms of timeline that you have. So actually we were taking some of the development risk. But our approach was really coming directly from their mindset as infrastructure investors. So we were spending a lot of time and money on working with the developers, on structuring the right contractual framework to bring project finance and having the perfect bankable project, spending too much money on it. And so we had actually a deal in West Africa, in Benin. We were supposed to fund two companies at the same time through an asset co approach, so we were just taking the asset risk. And what happened was that we were post-IC at our level, so we had the approval to go for the two developers at the same time. But after the IC, one of the developers called us saying that their EPC contractor, which was a key component of the bankability of the project, dropped the opportunity. So obviously that was the closing of the EPC contract was one of the CPs for us to disburse. We did not disburse. For the company, for the developer himself, it was a CP for his own fundraising at equity level for the corporate. So it created a snowball effect where at the end the company went into a very complicated situation. And what is interesting as well is that for us it was, we had to take this decision after having funded 50 mini-grids in two countries, Sierra Leone and Uganda, with Winch, who went bankrupt during the construction of the sites. So we already had an idea of the limits of the project finance approach. We ended up having to internalize the operating teams, externalizing and selecting a new operator in Sierra Leone because, I mean, we were not supposed to have staff ourselves, so it was really an asset co-play. 6 months after the commissioning of the sites, we had to restructure the debt because we raised the debt pre-construction. So that was already quite a good signal that this thing was not working properly. But given the mindset and the DNA of our investors, we were following that path a little bit stubbornly, I would say. But you have to test this once, twice, third time, think it through well. I mean, that's really the key lesson, but it's a very good example, actually, of what we are saying. That, I mean, for Zafiri, I think that I will use this track record and this experience to make sure that we don't have to go through that, because at that pace, I mean, that's not the type of approach that will help you to fast-track the deployment of mini-grids.
That's a hard question. So for hardest reach, because we are reaching 17 different countries, we actually have 2 different vehicles. I'm actually representing the debt vehicle, which is $200 million, and we have $50 million vehicle backed by philanthropic capital and grants, so that we can actually make a bolder move into the countries where market is not functioning yet for the DRA sector. And there, we actually look at we are trying to find the local company who distribute the solar home system, who's not there yet in operational capacity, but who has the potential to be the champion in the country. Because some of the countries that we went to, maybe one of the, like Somalia, the awareness of the solar home system is not there. Then, the players are not there. Then we need to showcase the benefit of this product for the customers. That's the starting point to build the market. Then we actually met 5 different local companies. And then I learned a lot by meeting with those entrepreneurs. Entrepreneurship in Somalia is amazing and embedded as part of their life. And we actually looked into 5 different countries. And then, so the deals that we actually couldn't close at the end was, for this very early stage investment, it's all about the management team. If this management team has local contacts, if this management team has a vision to start from the very, like small operation, but has a vision to expand into across the Somalia and beyond Somalia, and can they be a change maker in the country? So most of the time, when we look at the deals in very early stage, it's mostly the management team.
I think I can echo what is mentioned. So, I mean, ultimately, what we look for is to sort of, we don't expect the mini-grid company to be profitable within the next few years. Most of the C&I companies today are not profitable. But we need to sort of get comfort that eventually there is a path to profitability. So I think that's most of the discussions we had with our IC and deals we brought forward to the IC circled around that point, that the business, the operational model, the contracts in place, that they don't provide the comfort that eventually this company will reach profitability.
Great. So those are a few very concrete examples of what's kind of not able to reach the finish line on financing. So we wanted to turn it over now to you. You've heard a lot. Great. I already see hands shooting up. This is great. Maybe, Caroline, I'll let you decide which questions we take. And please direct who your question is to.
Thank you. I think my question is directed to either 4 of the speakers. I just wanted to ask, because I think based on the presentation that has been done, economies of scale are quite a huge thing. Then where does it put countries like my own, Eswatini, with 1.3 million people and 85% electricity access, but we still want to pursue mini-grids as a business? I think we also have the Comoros with around 200,000 people, because then sometimes you do find that we want to participate in these initiatives, but it feels like we are being punished for not being productive in terms of being a huge population or being from a small country. Do we have packages that would be suitable for smaller markets? Because we also want to participate in this transition. Thank you.
Unfortunately, I don't see a hand shooting up to answer the question.
I actually think the question goes to Don. That's an M300 question.
I almost said, I'm not answering questions. I'm the moderator. You know, I would say, you know, we have to find a way. One of the things that we also try to do at IFC is, you know, we develop these partnerships, not just with clients, but a lot of companies. We try to see if we can get our clients to go to those places, right? To the extent that we can set up corporate funding facilities that's open-ended in terms of exactly how it's used because it's done in a portfolio. How do we get some of those companies to say, listen, we really need you to go to Comoros to be able to do this? It is going to be hard to do it as like a ring fence, getting a company to just do that. But can we maybe bring somebody there to make sure that the funding still flows to those countries? That's just an idea. I'm not saying we've done it or it's going to work, but that's what I would offer back as a response, unless anybody in the audience has a better suggestion. Okay.
No,
Ed wants to answer?
maybe.
And regulated returns.
Everyone's intrigued. Look at this. Hello.
Oh, thank you. No, if you can do rural access concessions, which are large single concessions with multiple technologies covering the unconnected areas, and you can make it look like a regulated utility model where you get a guaranteed regulated return, then it's bankable. And your companies can do it, and they can finance it. You might not have dozens or hundreds of mini-grid companies emerging, but I do think it's very important that you have ways for, perhaps if there's a large operator who takes on that concession, what are the roles for smaller local companies in actually operating it on the ground in that partnership? I do think there's a really important partnership approach that needs to happen between these larger companies and the smaller local ones. But I do think that sort of model, and these people will say if they can finance it, but on paper, I think it can be workable.
Great, thank you. So my name's Sean Fury from the Rural Water Supply Network, based in Switzerland. And one of our members, I think it's probably to do with, is about a lot of our members now are building solar pumping systems, small pipe systems. So I just wondered, well, they're wondering, is there any appetite for combined investment in electricity mini-grids for rural areas with water mini-grids?
I can speak to that actually, because I used to sit on the board of a solar-powered water pumping company. I think my favorite thing about mini grids or metro grids, given the scale, is the ability to layer on other things. I'm part of a founding team that also is working on agrivoltaics, so making sure that we're also co-locating and taking advantage of PV in the agriculture space, whether it's shading, it is for the livestock, it's advantageous for certain types of crops as well. And so I think, I don't have a direct answer, but I think anything that can essentially off-take power to a mutual benefit, very much so. And I think this is the challenge for commercial investors when we look at pure rural mini-grids, that oftentimes the grid is built and then productive uses, I won't say an afterthought, but it's built in after, or it's scaling up, it's going to scale up. So if there's a case where there's zoning, where it makes sense to do agricultural water pumping, for sure. I've seen the case where large-scale water pumping for a town is a key off-take for a grid. And so I very much believe that in addition to, I think Vivienne was talking about batteries. So the charging of batteries and batteries as extension of those grids is possible. I think everybody also talks in the rural sense about the life cycle of the rural crop. So being able to then layer on cold storage, pack houses, so that you're extending the life of the agricultural product as well. So not just a single solution in the sense that you're pumping water for growing, but then you're also making sure that the product gets to has a chance to get to market, has a longer life. And so I very much, I mean, the whole reason I became a developer is because I believe the single electron is the basis to build everything. And so more thinking like this, more cooperation like this makes a better commercial case for then us to be able to invest in the portfolio or the platform over the lifetime of the investment.
Well, for me, it may be a bit early to talk about the Zafyris mandate, but just to be clear, what we want to do is to fund profitable companies. So as long as one of our key mandates, which is energy access and electrifying many connections, if there are additional businesses that support actually the profitability of the company, I mean, we don't have any reason to channel directly the funds straightly to the final connection. So the objective is to build sustainable companies as well. So, yeah.
Hi, I'm Nicole. I want to say the quiet thing that I think I've heard people say, but not said it out loud. But they were like, why isn't anyone saying this? So what I've heard from a number of mini-grid operators throughout the course of the past 24, 48 hours is a little bit of agita about the push for platform and the push, which implicitly becomes the push for consolidation. And I say this in part because folks who have talked to me, I've actually been an advocate for consolidation for a long time because of where I personally see the constraints in the market. But I also recognize consolidation's hard. And it's hard from a perspective, having started my career as an M&A banker, it's hard that it takes a while. And we're dealing with a timeline that's short. And so by putting kind of this, it's potentially a delaying factor as opposed to an acceleration factor, or maybe you get both in the same time frame. So from that perspective, I have a question, but then also, when you look at mini-grid companies, some of us are approaching profitability, and it's been hard won, but we're all over the place. We've all been operating in constraints of scarcity that many of us have survived. Should be like why we get certainly halos in heaven, if not prizes every day. And we survive by making choices and some of which are not consistent with best practices, but it is how we got from last year to this. So I'm asking this for the folks in the platforms who are talking about platforms, both. How are you thinking about timing, and how are you thinking about the choices of how you evaluate a platform or a combination, because these are all companies that have made choices. How do you evaluate that in a way that actually moves the market forward, knowing that none of us are going to be perfect? So what is it that you're looking for, in short?
Yeah, I think it's a bit for me as well. So, to be clear, we are just starting to think about the approach. So it's we prefer to take the right time to think it through and to make sure that the approach will be the right one. The reality today of the market is that you have complicated cap tables, balance sheets that are not fit for growth. So all that will have to be looked into the details, and then how, as you said, how can we organize this consolidation or the creation of this platform without putting the deployment on hold. So there are some possibilities. We are starting to think about it, on my side at least. That's one of the key elements of my first 100 days. But I think that there are solutions. It's just that we need to make sure that, as you said, I mean, there are millions of dollars to be deployed in pipelines that have been on hold for the last 2 or 3 years. So I'm confident that actually we can make a significant part of the Zafyris objectives in terms of connection through mini-grids, but it will happen through the approach you're just describing now. Not only, obviously, there are different approaches. We will diversify the risk through different business models, but again, you have different ways to organize an M&A operations. So, but we can talk in a couple of weeks or months, and I think we will be more ready for that.
Maybe I can add. Thank you. You know, M&A is like marriage, right? So on the paper, it looks amazing, but when we get married, we, face a lot of different issues and problems in day-to-day life. So that's actually what's going to happen, right? But this is what we need to make. We talk a lot about bankability. If this is one way to make our project bankable and having more sustainable liquidity to the sector, how can we do it in the right way? Then I think if we want to put together a platform, the ownership structure, governance should be the key. So who does what, and it has to be very clear from the very beginning so that we don't, each of maybe like multiple operators don't step on each other's toe, but it has to be very clear who does what. So yeah, that's actually something that we have been looking for. And then we definitely, we can't work for consolidation in silo. It has to be, if it's a consolidation and big platform, then we have to work together. Equity provider, lenders, and we have to layer our products together as well to make a whole project bankable. Because, if we have this idea of consolidation and start with the equity provider, but we have to look at the long-term vision as well. Otherwise, when we have issues in a platform level, we will start fight more, right? So I think we need to start from very transparent and clear roadmap.
I think to be fair, we're using platform and portfolio interchangeably. I think when people think of a platform, they're thinking, okay, I invest in Energicity and she goes and buys NOAA and she buys Renuvia and she buys all of these type of things. That could be one way to get a platform, or it could also just be a more robust portfolio of differing types of grids within the same country that has the same regime, has the same regulation, and so maybe even the diversification of the size, scale, and commerciality of the grid. So across the portfolio, you have different push and pull that lands somewhere that's a little bit more commercial. So I'll just say that to start. I think also efficiencies in capital use. Look, return on equity is a really important metric in asset-heavy businesses, right? More than MOIC on an exit, but we actually want to make sure the capital that we're putting in is actually, building and scaling in the ways that we want. And so, operational efficiencies, processes, the ability to work with government, a concession or permit, depending on where you are, but even larger scale, because it's let's call it a portfolio of grids. Being able to bulk buy from an OEM, I guess in this market now, with oversupply in China on panels and batteries, being able to then directly negotiate so your capex is lower and you're going longer. But I think on the back end of all of that is you have a team that can deliver that. And if you were to, acquire stranded assets, either stranded or distressed assets, what would that integration look like? So to your point, nobody wants to roll up problems. Nobody wants to consolidate issues, right? But I think on the back end of Spark Meter going through what it is, all of you have had to now figure out your meter solutions, whether you're making them yourselves or is it going to turn off tomorrow? And so I think groups like this, groups like AMDA, where you guys work in tandem, is very important in terms of lessons learned, efficiencies, so that as we look to scale, we find the transaction that makes sense for the areas that we're looking at. I think that the idea of a platform obviously feels good, but I remember when I was a developer and we started, when I left the gas, I'd done gas, but we were doing small-scale solar. I don't even call them grids. I want to probably say they're more captive CNI. We were looking to build those portfolios full equity and then back leverage the entire portfolio, right? And so I think we need to be innovative and also appropriate for the type of consolidation depending on the geography or the technology that we're looking at.
Very patient question. Not quite a question, but just a contribution to the Swatini question. If you think about it, so my name is Anam. If you think about Eswatini, it's surrounded by South Africa, Lesotho, Botswana, but then you also have the South Africa power pool. So if your grid is then connected to the power pool or the grid infrastructure, then you're thinking about a much larger market. So although you are small as a country, you can think big, because there are lots of companies in South Africa that need clean power today. So just to make that contribution. Thank you. Any other burning questions? Oh, we thought it would be a mad rush. Well, that means the panel was excellent and all speakers were excellently articulate. No, but really, thank you. Can we get a round of applause? That was a wonderful panel. And also the session before, all speakers today were fantastic. It's been in high demand, so it's really just wonderful to have the quality of the speakers that we've been able to have today. If I may, Don, should we move? Okay, so we're now moving into the final session, so we'll have a coffee break. So there's a coffee break just outside the door, so we don't lose any of you for the final session. The final session is on big picture thinking, looking at integrated energy systems. We'll touch a little bit on RBF and some of the topics that were brought up today, but it's really about breaking silos. So please rejoin us in about 15, 20 minutes. Thank you. Big round of applause for Don Perker as well as the moderator.